They tell you the price of money is set by a committee. A vote, a press conference. That's the official story. But here's the uncomfortable truth. If they really controlled it, why does money keep surprising them? Because the real price of money doesn't live on a stage. It lives in stress, in panic, in leverage. It lives in places that don't give interviews. And right now it matters more than most people want to admit. For most of modern history, the price of money felt boring. Rates went down, assets went up, and debt felt manageable. Then inflation came back with a vengeance. Rates jumped. And suddenly, everyone started asking the same question. Who actually decides how expensive money is? Officially, it's central banks. The Federal Reserve, the European Central Bank, and others like them. They set a policy rate, a number that acts as a signal. But that rate is just the opening move. Think of it like this. A central bank can announce the weather, and it can even try to see the clouds, but it doesn't control the storm. Here's how the system actually works. At the very center is a promise. Governments borrow money and promise to pay it back later, with interest. Those promises are called bonds. And everything else in the financial world is built on top of them. Mortgages, corporate loans, stock valuations, even how risky a new startup feels. When investors buy government bonds, they're agreeing on a price for safety. A low yield means confidence is high. A high yield means fear is creeping in. Central banks try to influence that price by nudging short-term rates and buying bonds themselves. But they don't set the final number. Markets do. And markets aren't a single mind. They're a huge, chaotic crowd all reacting to incentives. Now, here's where it gets uncomfortable. Most of the global financial system doesn't run on savings. It runs on borrowed money layered on top of more borrowed money. Banks borrow short-term to lend long-term. Investment funds use leverage to boost their returns. Governments roll old debt into new debt. This whole delicate structure only works when the price of money stays predictable. So when central banks raise rates, they're not just fighting inflation. They're pulling on a single thread that runs through every balance sheet on the planet. If investors start to believe that higher rates will break something, they demand more compensation for the risk. Yields rise. Borrowing gets more expensive for everyone. Stress spreads. At that point, central banks stop being leaders and start being responders. History makes this crystal clear. In 2008, rates weren't cut because inflation vanished. They were cut because the entire financial system was cracking apart. In 2020, rates went to zero not because money was cheap, but because panic was incredibly expensive. And in recent years, runaway inflation forced central banks to tighten into a system already drowning in debt. That is the hidden mechanism. The true price of money is negotiated between official policy and real-world pressure. Publicly, we're told a clean story of independent central banks with careful models and clear mandates. Behind the scenes, it's much, much messier. Every single rate decision has to answer an unspoken question. What breaks if we go further? The housing market? The banks? Government finances? Pension funds? Sometimes the answer is nothing yet, but sometimes it's something very important. That's why smart money watches bond auctions more closely than press conferences. It's why long-term yields often move before policy changes. It's why confidence matters more than credibility. The irony is subtle but brutal. Central banks were created to control money. But the more debt the system carries, the less control they actually have. High debt narrows their options. Low growth traps them. And financial markets can price in fear much faster than any policy can respond to it. Over time, this shifts power. Not to voters and not even to governments. It shifts power to whoever can look at the system and say, I won't lend at that price. And that's rarely a single person or institution. It's a vast web of funds, banks, insurers, and foreign governments, all reacting to the same fundamental incentives. Zoom out far enough, and the picture gets even stranger. The entire global economy depends on trust that the money of the future will be worth something. That trust is enforced by interest rates. And interest rates are enforced by belief. If you lose that belief, the price of money spikes. Not because a committee voted, but because confidence just walked out of the room. So who actually controls the price of money? It's not just central banks. It's not just markets. It's controlled by the constant tension between debt and credibility. Between the promises we've made and the patience we have left. Between how much the system owes and how much risk people are willing to carry. And here's the thought that should linger with you. If the price of money is ultimately set by what the system can survive, What happens when survival itself gets more expensive? Thanks for watching. If you found this interesting, consider subscribing for more.